Realizing the American Dream on BCTV is supported by the Santander Bank.
Good evening, everybody. Welcome to Realizing the American Dream. Hope everybody's doing well tonight. If you're watching this live, it's kind of poopy and rainy out. It's getting into that fall weather, getting close to Halloween here. So tonight, what I want to do is I'm going to talk a little bit about credit. The credit is one of the most important things that you can possibly think of when it comes to getting a mortgage, and not only getting one, but getting the best priced mortgage. Almost everything right now is being priced based on what they call a risk analysis. So not only is the pricing of the mortgage being based on that, but also the pricing if you need PMI, for example, if you need homeowners insurance, all that stuff, everybody's looking at your credit report. So it's very, very important. And knowing how to generate a credit score, especially for you young home buyers out there, or people who like to use cash, it's really important that you actually have some kind of credit history. And we're going to talk about that in a little bit too. Before we get into the main part of the program, what I want to do is just talk about where the economy is kind of at this point, the market in general, and this is kind of a nationwide thing. I mean, the economy is doing really, really well, in spite of what some people may think or what you may hear. Employment is doing better than it's been in 5 decades. The problem with the housing market is there's not enough houses out there right now. There's a lot of demand because employment is up, wages are up, interest rates are low, and that's amazing because normally when the stock market is at record high levels, you would see higher interest rates. But fortunately at this point, the way the structure of the economy is, there's not been a lot of inflation. They've kind of kept that under the certain level that the Federal Reserve likes to see it at, which I think is 2%. So all that being said, they really haven't moved rates that much. As a matter of fact, the Federal Reserve bumped rates down just slightly over the last few months. One of my customers came to me and said they thought that they heard that the Federal Reserve was going to drop rates more. I don't really see that coming unless we see some negative signs in the economy, but that's really not happening at this point. So all that being said, internationally there's some issues, and that does affect us a little bit as far as, there's some international buyers for our goods and services, but outside of that, the economy here within the United States is going very strong, and we're kind of leading the world at this point. Eventually, if everything keeps going in that direction, we'll probably pull the world up, but we'll see what happens because there's other factors involved in that too, wars and whatever else is going on out there. But like I said, interest rates are still low. Stock market is at record highs, so people have some extra cash out there. If you guys have some investments, so you might have some money for down money. And interest rates right now, I think we're in the upper maybe 3.25 or so for a 30-year fixed rate, which is still incredible. I mean, I think the historic lows may have been an 1/8 or 1/4 below that. So we're very close to that bottom that they've ever been at. So your purchasing power is really good at this point if you have good credit. So here's the key thing. In order to take advantage of those best rates, now you're going to get a great rate no matter what you do, but in order to take advantage of the best rates, this credit thing is really, really important. So what I want to do is focus on that a little bit. In my opinion, they should start spending a little more time on finance and credit, holding a checkbook, things like that in school that are important to people throughout their lifetime, as opposed to maybe some of the other things they spend time on. But that's just my opinion. Those are worth. So anyway, let's move over to the board and let's look at this credit thing for a little bit. What I'm going to do tonight is I want to give you guys not only an idea of how to create credit, how to fix credit, what the credit scores are based on, because it's very important that you understand that if you are going to fix your credit or maybe generate this credit. So we'll take a look at all that stuff. So let's move on over here. All right. So when underwriting, if you'll remember, is the underwriter is the person who actually looks at a loan application and decides whether or not it's approvable. When they're looking at it, there's a couple of things they're going to look at, and the credit is an indicator of not only willingness to pay, because if your credit history is good, if you owed somebody money and you made a payment on the credit card or the car loan or whatever it was, you're willing to pay it, obviously, and that's a big factor here. Now, also, it helps with determining the ability to pay. So what we do is we're going to look at what the income levels are, what the debt levels are, and we're going to look at a ratio. We're going to say, okay, the debt is available to be up to a certain percentage of what the income is. And we think that at that level, it's safe to give a loan out. But if we're giving loans out and we say, okay, well, their debt level is at 90% of what they're earning, chances are that's not really sustainable, especially, you start taking taxes and stuff out of it. And if you have a bad month, then you're underwater. So, generally most loans at this point, when we're going for a mortgage loan, we can go up to about 50% debt to income ratio. And what I mean by that is that's all your car loans, credit cards, and then also the new housing payment, which includes your principal, interest, taxes, insurance, and PMI if that's factored in there. If you have a homeowners association fee, that'll get factored in. But all of that is looked at with the credit report to help determine whether you have the ability to make this payment. So, coming over here. All right, so what kind of things in the credit affect the credit scoring? And by the way, I wanted to mention too, so a lot of people call me up and they go, oh, I have an 800 credit score, and then I pull their credit and it's a 640. And as a consumer, you have access to certain credit scoring mechanisms that you can look at. Maybe it's through a credit card, maybe it's something else. There are different scoring scales out there. So the consumer credit report that you may look at relative to the credit report that I get, and I get what's called the Tri-Merge credit, and it includes 3 different bureaus: TransUnion, Equifax, and Experian. And what they do is they take those 3 bureaus, each one of them has what they call an algorithm, which is a computer-generated model that's going to look at all of this stuff, and it's going to say, okay, your score is this based on all of that. And those algorithms are the determining factor. And then we take the middle of the 3. So we're it's not really an average, but they pick 3, take the middle one, and they figure that's a good indicator of what your actual credit score is. So our credit score when I do a mortgage is usually a little bit lower than what you might see as a consumer credit report. And you can expect that. And that's fine because we go on a lower scale. So I think the consumer credit report goes on a scale up to 950 is the top score, whereas ours is only 850. So it's going to be scaled down a little bit right across the board. Just to understand that. Now, as far as history, what goes into your credit history and what does the algorithm look at to see and determine what that score is going to be? Payments, obviously, is going to be a big one. If you have a payment due and you make a payment, that's going to help with your score, okay? So payments are going to be out there. If you have no credit at all, that's as bad as having bad credit. Because without this history in here, what's going to happen is the algorithm is going to look at it and it's going to say, well, there's no history there. We can't generate a score. So you're either going to get a really low score or you're going to get no score at all. And that does not help you get a mortgage. You have to have at least 2 scores normally. Back in the old days, we used to be able to generate what's called alternative credit if you had like utilities and stuff, a cell phone bill, things that didn't necessarily report to the credit bureau. We could take those, get a history from them. If you gave us if you say, hey, listen, I have an account with Verizon. It doesn't report to credit. It does report to credit if you don't pay your bill. Then you get a collection account. But if you just regular monthly payments, it doesn't report. So they could say, okay, well, we have Verizon, and we call Verizon up and they say, yeah, they've had Verizon for 36 months and all the months were paid on time. Then we can generate a credit report from that, and we can send that information to the credit bureau. They'll generate an alternative credit report for us. Most cases, we can't do that anymore, so you really need to generate a couple of lines of credit. So moving on, so the payment history obviously is the big one. Bankruptcy, if you have any bankruptcy issues. Obviously, that's going to show up in the credit report because that's default on credit. That'll affect your credit substantially. In most cases, you can't do a loan for a couple of years after you have a bankruptcy. It's going to depend on what the circumstances were. It will dictate how long you have to wait. It might be 2 years, it might be 4 years. If you have a foreclosure on a property, on an actual mortgage, then it backs it up to maybe 7 years. So all those things come into play. Collection accounts. If you don't make your payment on your credit card, after a while, what's going to happen is they're going to come out there and they're going to sell that debt to a collection agency. Collection agency is going to slap that onto your credit report, and they're going to say, okay, this is a collection account for whatever amount, and then you have to deal with that. Because if you ever do go to get a mortgage and you have collection accounts out there, yeah, chances are you're going to have to do something with them. Judgments usually happen if you've got maybe a lawsuit or maybe an outstanding child support or something like that. Those things pop up too. Again, it's derogatory. It shows up on the credit. It's going to affect your credit score. Foreclosure, mentioned that earlier. That's something, if you foreclosed on a property, that's big. That makes it really difficult to get a loan. Deed in lieu, again, that's similar to a foreclosure situation.
Charge-offs are something, let's just say you have a car loan and maybe the car gets wrecked and you don't want to pay the rest of the bill off and you negotiate kind of with the dealer and, well, it comes down to it and you pay off part of it, don't pay off all of it. They may charge off a part of the balance. That shows up on your credit report as a charge-off. You may or may not have to pay those off depending on what kind of loan you're going for, but it also shows up as a negative, so just be aware of that. Short sale also, depending on what happens with your payment history on a property, if it goes into short sale, if you sell it for less than what the actual loan amount is, so let's say you owe $100,000, sell the house for $90,000, can't pay the thing off, the bank may put that out there and say, okay, well, it's kind of like a charge-off. There's still a balance available even though you did sell the property and paid off most of the loan. So all these things are going to show up on the credit report. Structure, when I talk about structures, there's different things that can show up on there. Again, there's some things like utilities and stuff, and we're going to get to that in a minute, that may not show up on the credit report, and we'll talk about why. Mortgage, home equity lines, that's all going to show up. These are good lines of credit. Credit cards, car loans, personal loans, just personal lines of credit, things like that are all going to show up on the credit report because all of these vendors will report regularly to the credit bureau on a monthly basis. So these all help to generate a credit history. What I normally tell people is you want to have at least 3 lines of credit out there, whether it's a couple of credit cards, a car loan, any combination of these things. Normally 3 lines are what it takes to generate a decent credit score. And you need a little bit of history there, maybe 6 months or a year of history will get you that best credit. So be aware, if you're like, oh, I want to pay everything cash because I don't want to get behind, you really do need credit. And here's the deal too, with credit cards, what I tell a lot of my customers, if I'm counseling a first-time home buyer maybe, what I'll say is go out and get like a Wawa card or maybe a Boscov's card or a Sunoco card. Things like that you can put a small balance on every month and make your payment. Because by doing that, again, you're generating history. What you want to have is a payment due, payment made. It shows up as a little 1 on your credit report. And you see a whole bunch of these 1s for every month that you had a payment and you made it. That's all good stuff. And that's what generates this history that we're looking for. Other stuff, medical bills, utilities, things like that. A lot of these things don't report to the credit bureau. So, on a normal basis. Now, the only time you'll see this stuff pop up is if you haven't made your payments. So, for example, a medical bill, a lot of times what happens is you have a little deductible or something. So, and I see these all the time. They're dumb things, but you go to the doctor and you have a $10 deductible and you don't pay it and the doctor never calls you, but they just sell off all that debt at the end of the year to the collection agency. And they throw a collection on you for 10 or 20 bucks. It's dumb, but it wrecks your credit. So you got to be really careful with those things. Moving forward. All right. Here's some other things that it's going to look at. Number of accounts. So, if you have a ton of accounts out there and they are, just a bunch of open accounts and you're not using, you don't have to keep them. If you have an account that's been open for years, I have some customers come to me and say, well, listen, I don't want to close the account out because it's part of my history, but if you haven't used it in a couple of years, it's not really affecting your history. Again, the algorithm isn't really going to look at that. All it's going to see is that it's an old account, nothing going on, no balances, nothing happening. It doesn't affect your credit that much. Utilization and balance to limit. These two kind of go together, and this is a big one. And this is one that most people don't really understand or realize how much this affects your credit score. So the utilization ratio is, let's just say, for example, you have a credit card that's got a limit of $1,000 on it. If you have a balance of greater than $500 on it, or greater than 50% of that limit, that's going to look like a derogatory or a negative to that algorithm that does the credit scoring. So what you want to do is you want to try to keep those balances below 50% of the limit at all times, or at least if you know somebody's going to pull your credit, make sure you have these things paid down. Because it looks like to the algorithm that you have your stuff close to maxed out when you get it above 50% of the limit. And again, that it views as a very negative situation. So be very, very conscious of this because that is really, really important. Now, one of the issues here is student loans. And, I'm actually at a college right now, so some of the people in this room may be thinking about this going, all right, I have student loans. Here's the deal with student loans. Even if you never have a late payment on a student loan, as soon as you take that student loan out, it looks like it's maxed out. Because if you take a student loan for, let's say, $10,000, and they give you the $10,000, and you go and pay your student bill, and then it's deferred until you graduate. That's all well and good. So whether you're accruing interest on it or not, if it's deferred, it already looks like it's a maxed out line of credit. Because it says the maximum is $10,000, it's at $10,000, and on some of these accounts, depending on what your status is, you're accruing interest even though the thing is deferred, which means you don't owe a payment on it until you graduate and find a job. But what happens is, now it starts out at $10,000, but by the time you start paying on it, it might have $11,500 on it. Now it looks like you're over the limit, and that looks bad to the credit algorithm. Unfortunately, it's a computer. It doesn't understand. It's not compassionate. It doesn't say, okay, well, this person's bettering themselves by going to college so they can get a better job. All it does is it looks at the fact that you had a $10,000 limit and you now owe $11,500 on it, and it's going to ding your credit. So be aware of that. Once you graduate, look into that, getting those things paid down, maybe doing a consolidation. Because a lot of times people will go through, and every semester they have new student loans, and you may have 8 or 10 of these things out there. Now it looks like you have 8 or 10 accounts that are all maxed out. If you consolidate that all into one, now you have one maxed out account. Again, it all comes back to that structure we were talking about earlier, making sure the structure of your credit is the best it can be to generate the best score. Okay. Activity, this is another one. So if you have a lot of activity going on the credit report too, balance is going up, balance is coming down, opening new lines of credit, things like that. And every time you do go to open a new line, let's say you go to a car dealer and the car dealer says, okay, we're gonna look at this and see if we can get you a good loan. And then the car dealer goes out and they do inquiries with 9 different financial organizations looking for the best rate for you on your car loan. All of those inquiries show up, and every time that inquiry shows up, the algorithm, I like this word if you can't tell, I was a math guy. So that algorithm takes us and they look at it, and it goes, okay, look at all these inquiries. They're opening 9 new lines of credit. And then the algorithm goes, oh, well, we're going to knock down the credit score by 40 points for that. So anytime you have these inquiries in here, that's part of your activity, that is going to affect your credit score too. So it's something else you want to be careful of. Now, something with mortgages, and some of my competitors are out there and they play this game where you go to them, if they're the first person that pulls your credit and you're shopping around for a mortgage for the best rate and best program, they'll tell you, don't go anywhere else because it's going to hurt your credit score if somebody else looks at your credit. Absolutely untrue. If you have a mortgage inquiry and you have others within 30 days, that will only count as one inquiry. That's not going to hurt your credit score. Others, like these car loans and stuff, yes, it will, but not for mortgage. You have a 30-day window to shop this around without it dinging your credit. So be aware of that. Disputes. I'm working with a customer right now who went and they actually had a mistake on their credit. And it's totally a mistake, and they have proof that it's a mistake. But until they get the vendor, the store that they went through to remove it from the credit, it's showing up on there. Right now, they went to the credit bureau and said, listen, this isn't mine. All the credit bureau is going to do is they're going to go, okay, well, you're disputing this, and they're going to put a little note on there. So in this particular case, this account rolled into collections, and it's not my customers. But the credit bureau, all they've done is they put a little note in here and says dispute, but the algorithm is still going, oh, well, they have a collection account, and it's still affecting the credit score. So the key to something like that is you want to get things like that totally removed from your credit. You have to get the vendor to remove it. You can't remove it. You can't have it removed. They have to remove it. But if you just go and complain to the credit bureau, they're just going to put a dispute label on it. It's not going to help you. All right, so what can this affect? If your credit score is poopy, so if your credit score is poopy, first thing that's going to happen is it's going to affect your pricing on your loan. For example, it can be a swing, a substantial swing that could cost, thousands of dollars or 0.5 to 0.75% in rate, which even if that's not thousands of dollars up front, over the life of the loan, it's significant. You're paying a lot more. So let's just say 0.5% on a $100,000 loan, you may be looking at 50 or 75 bucks a month difference just because your credit score is bad. So what you want to do is you want to get these credit scores as good as possible because it's going to affect that. So it's either going to affect what your interest rate is, what your points are, the pricing in general up front will be affected by it. approval. It can affect whether you're going to get approved or not. So, depending on where the credit score is, there are minimum credit scores out there that are allowable for most loans. So FHA has them, regular conforming loans have them. It also affects, what as far as your debt limits and stuff. So all that stuff is going to play into it, but that could affect whether you get approved or not, and that's very important. Program. There are some programs out there that have the limits, like I mentioned, with the FHA and conforming. So you're going to have to look at that too, because what it may do if your credit score is too low, it may lock you out of the program you really want to be in. So, for example, the right program for you might be a 5-year ARM, because you're only going to be in this house for 5 years, and that would save you 0.75% in interest rate, but you can't go into it because the 5/1 ARM has a limit as far as the credit score that's not as low as what the 30-year fixed conforming might be. So again, it could lock you out of the program that you want to be in. LTV, loan to value. This is also another thing. So for example, if the credit score could dictate how much you have to put down on the property. So it'll affect, let's just say, depending on where the score is, you may have to put 20% down instead of 5% down. And again, that may just stop you from purchasing the house altogether. So credit will have an effect on that. PMI is another thing I wanted to talk about. Let me see what's over here. I forget what I put in here. Oh, this is it then. So PMI is another thing that I want to talk about too. So PMI back in the old days used to be a multiplier factor. And what I mean by that is the PMI, if you were putting 5% down, the multiplier factor used to be 0.0078 times the loan amount. So for example, if you were borrowing $100,000 and you're putting 5% down, 0.0078 times the $100,000 is $780. You divide that by 12, that's what goes into each monthly payment. So, you're there with like maybe $65 a month or whatever it might be. Now, what's happening with PMI is that multiplier factor, it's a risk factor again, just like the pricing of the mortgage itself. So the PMI, that multiplier factor is dictated by the credit score. So if you are putting 5% down, it used to be 0.0078, it might be 0.0121, which is substantially higher. What that means, now you're paying $1,200 across the year instead of $780 a year. Obviously, that adds into your monthly payment when you divide that by 12, because now you're paying over $100 for PMI per month as opposed to paying $60 or $65. If your credit's really good, though, it could be as low as maybe $500 a year. So now you're paying $40 instead of $65. So you can see where I'm going with this. That credit score, if it's good, you can derive benefits from it. But if it's not, it's going to cost you. Okay? So all this stuff kind of came around and came into being after the mortgage crisis. What they did is they started looking at this a little more closely and saying, okay, we're going to base this stuff on risk. And before that, they were just kind of keeping everything on a level playing field. But now your credit score really factors into everything. So I hope this helps. I hope you guys have a little bit of understanding about credit. If it comes down to getting pre-approved, or you start looking into this, or you're thinking about buying a house, if you have time and if it's just a fresh idea in your mind and you have 6 months or a year, go look into getting pre-qualified way ahead of time if you can. Make sure. That way, just in case, and sometimes stuff, like I said, my customer had something that was not even his. Sometimes these things pop up in your credit report, especially if you have a very common name, if you've had identity theft, all that kind of stuff. Give yourself plenty of time, because if you run out today and you need to put an offer on a house and then you try to get your pre-qualification, you're kind of stuck, okay? So you may end up stuck with that, whatever pricing that is, then the only way to get out of that is to refinance, and you don't want to have to do that, especially now when rates are at all-time lows. You want to take advantage of the low rates right now and lock them in. Okay, that's it for tonight. Have a great night. Stay out of the rain. I'll see you guys next month, and that's it. Good night.
Realizing the American Dream on BCTV is supported by the Santander Bank.